Welcome to Banking 101, a first principle jargon-free course on banking. So far in this course we have developed an understanding of the ecosystem banks operate in. Now, we will dig into the operations of banks themselves. It is as though we were studying the neighborhood, and now are ready to step inside the house. In this lesson, we introduce the four major product categories provided by banks. We will then do a deep dive into consumer banking products. We will cover the remaining product categories in subsequent lessons. So let us get started. Before we dig into what banks do, we will recap what we have learned in the previous lessons. First, we define financial assets as physical or digital symbols that store economic value. The major categories of financial assets are currency, debt, equity, derivatives, and certain categories of crypto assets. Then, we define financial products as services that create, store, preserve, grow, and move financial assets. Next, we define financial services ecosystem as a set of businesses that provide or enable the provision of financial products through. Finally, we define banks, the focus of this course. We learnt that banks are a subset of the financial services ecosystem who have a banking license. We learnt that banks earn revenues mostly by selling financial products that they own as against enabling sale of financial products owned by others. However, in the marketplace banking model, the bank acts as a channel for products owned by others. We also learnt that while banks continue to be the predominant product creators, in banking as a service model, the financial product can be delivered by third parties who own the customer relationship. Banking as a service and marketplace banking are thus antipodal to each other. Finally, a subset of financial products facilitate capital markets transactions. They can range from a simple product like a brokerage account to complex services like IPO underwriting. While larger banks sell capital markets products, smaller banks primarily sell core banking products like deposits and loans. With this recap, we are ready to begin this lesson. Previously, we learnt that financial products can be categorized by the nature of the function they perform on financial assets. Specifically, financial products can create, store, preserve, grow, or move financial assets. We can categorize financial products into a more commonly used alternative taxonomy, consisting of four categories. The first two categories, consumer and wholesale banking, are defined by the type of customer the products are designed for. The remaining categories are defined by the nature of the financial products themselves. Consumer banking products are financial products designed for and sold to consumers. Wholesale banking products are designed for legal entities like businesses as well as governments. Asset management products enable individuals and businesses to invest their surplus funds for generating returns. While asset management products are geared towards savers, investment banking products are geared towards those who need capital. Thus, asset management and investment banking products relate to capital markets from antipodal perspectives. We can think of consumer and wholesale banking products as Main Street banking products, while asset management and investment banking products are capital markets products. Over 80% of global banking revenues are Main Street banking products. Consumer banking products are targeted towards individual consumers as against business entities. Historically, banks served consumers through branches. Over time, with the use of ATMs, debit cards, and phone banking, the number of branch visits made by a consumer diminished. However, the branch remained important for certain activities like opening a bank account or sending a high-value payment. With the rapid expansion of Internet, consumers are increasingly able to fulfill complex transactions through mobile and desktop channels. Hence, the number of branches and their size are reducing. There are also mobile-only banks, which eschew branches altogether. Consumer banking products can be further grouped into two subcategories. Cash management products, in which consumers park their cash and transact from. Credit products are products through which the bank lends to consumers. Let us look at each one of them. The two principal cash management products are bank accounts and payments. Cash management products include demand deposits, which allow consumers to withdraw and deposit funds at will. Time deposits typically lock consumers in holding funds for specified periods, and consumers incur penalties if they withdraw funds earlier. Demand deposits tend to be sticky because most consumers link automated incoming payments like salaries and outgoing payments via direct debits to such accounts. Hence, it is inconvenient for them to switch. Next, we will learn more about them. Demand deposits go by different names in different countries. Checking accounts, current accounts, and transaction accounts are some common names. In return for the flexibility of being able to withdraw funds at will, demand deposits earn no or very little interest. Within the broad umbrella of demand deposits, Banks may offer different subcategory of accounts with somewhat different product features. In the US, some common subtypes of demand deposits include checking, savings, money market, and high-yield accounts. While demand deposits allow anytime withdrawals, some subtypes that may yield a marginally higher interest rate may have restrictions on the number of withdrawals in a specified time period. Demand deposits can have multiple add-on products associated with it. At the basic level, given the transactional nature of these accounts, payment products like checkbooks, debit cards, and ATM cards are associated with them. Banks also allow bills of third-party service providers like cell phone carriers and utility companies to be paid either on a one-off or direct debit basis. We will learn more about payments in a separate lesson. The advent of fintechs introduced new value-enhancing services built on top of payment products. One of these is personal financial management tools that apply artificial intelligence to underlying bank account activity data to present us with spend analytics and budgeting ideas. Sub-accounts are virtual accounts tied to our bank account that allows us to segregate our money into buckets and serves as a budgeting tool. For instance, we could earmark a travel sub-account and keep setting aside money for a holiday we are saving for. Roundup feature allows the consumer to round up every debit card payment to the next whole number and automatically transfer the change to a savings account or an investment product like a mutual fund. Time deposits usually yield higher interest than demand deposits because customers cannot withdraw prematurely without paying a penalty. Like demand deposits, time deposits are called by different names across countries, including certificates of deposit in the US, bonds in the UK, and fixed deposits in India. The frame of time over which a time deposit matures could range from 3 months to 5 years. Given the non-transactional nature of these accounts, it is harder to build add-on products, though some banks have linked such deposits to investment products. For example, interest earned could be automatically invested in an equity mutual fund. It would not be very useful to have bank accounts if we could not pay out and pay into them. Payments is a service offered by banks that allows its customers to securely transfer value from a source bank account to another bank account and vice versa. This definition of payments as a banking product is very abstract and does not capture the ways in which consumers experience the products. Just as we don't buy hair products but instead buy shampoos, conditioners, and hair dyes, consumers experience payments in the way they interact with their bank. The underlying funds that is transferred to a beneficiary in a payment is held in a bank account. The funds may be owned by the payer, example when payments are made via debit cards or checks. Alternatively, as in the case of a credit card, the funds may be owned by a lender who is making a payment on the consumer's behalf at the point of purchase. Consumers access the payments product of banks through multiple ways. These include checks, cards of various kinds like credit cards, debit cards, and ATM cards. Consumers could also pay via digital wallets or online banking. Payments is a vast subject. We will defer the understanding of payments as a banking product as a separate lesson in this course. This brings to the end of this section on cash management products. We are now ready to discuss credit products. We can map cash management and credit products on a Venn diagram with credit cards and buy now pay later sitting at the intersection. These two products are both a payment product and a credit product. We will begin with them and then move on to the pure credit products. The payment aspects of credit cards and buy now pay later will be covered in the lesson on payments. In this lesson we will only focus on the credit aspect of these products. At this point, it is useful to define two terms that are commonly used in conjunction with credit products. First is credit risk, which is the likelihood that the borrower will not repay either the principal, interest, or both. As we go through subsequent lessons in this course, we will learn that a bank can be exposed to credit risk even when there is no loan being made. We will define credit risk more expansively in a later lesson. Underwriting refers to the process of deciding whether to assume a risk or not. In the context of consumer credit, this boils down to approving or denying a loan application. When a consumer uses a credit card to buy a product, either in store or online, the card issuing bank is also making a loan to consumer. The customer is assigned what is called a revolving line of credit. The line of credit is the maximum permissible outstanding. It is revolving because any time a consumer pays down a balance, the line is reinstated by that amount. This differs from a mortgage where principal repayments cannot be reborrowed. Credit cards typically have a minimum payment due at the end of the billing cycle. The terms including interest rate and late fees are outlined in a cardholder agreement. Credit card issuers make money from two sources. First, they take a small cut from every payment made to a merchant. Credit card reward programs are funded from these fees. We will learn more about this aspect in a later lesson on payments. Second, Consumers pay an annual fees and interest is charged to customers who do not pay down their card balances before due date. Credit card issuing banks differentiate their cards on multiple features. At a foundational level is merchant acceptance. This is heavily influenced by the issuing bank's participation as members in card networks. We will learn more about this in the lesson on payments. The next feature is rates and fees. In a competitive industry, it is difficult to differentiate on pricing. A major area of differentiation is in rewards programs. These take the form of points that can be redeemed for purchases as well as discounts that apply when the card is used at certain merchants. Finally, higher-end credit cards market themselves on prestige, including features like metallic cards and access to lounges. There are three major credit card types. Bank-issued and branded credit cards carry only the name of the card-issuing bank and network on them. In co-branded cards, the issuing bank partners with a third-party merchant like an airline. The consumer gets reward points that are redeemed with the co-branding partner, though the card can be used at any merchant. In private label cards, the issuing bank enters into an agreement with a third party, usually a retailer, and unlike co-branded cards, such cards often can only be used at that retailer. The next product we'll look at is Buy Now Pay Later or BNPL. Like credit cards, this is both a payment and a credit product. But BNPL is primarily used for e-commerce. The process begins with the consumer choosing BNPL as the payment option at online checkout. The consumer is then directed to the BNPL provider's platform. The consumer provides the method by which she intends to pay off the transaction, and if she passes the BNPL provider's credit check, the transaction is approved. Post the transaction, the consumer pays off the BNPL lender over installments, usually via a debit card unless so by credit cards. In fact, some BNPL lenders only accept payment via debit card. At the point of transaction, both the BNPL lender and the credit card lender is making a loan. The difference is that in credit cards, the loan is made to the user, and in BNPL, the loan is specific to a transaction. If a consumer made 5 purchases of $100 each using the credit card, the entire $500 is added to her card loan balance. In BNPL, the consumer is financing individual transactions. One transaction may be paid over 3 installments while another may be paid over 5 installments. What is the advantage of BNPL versus credit card for each player in the transaction? Next we will answer this question for each of the 3 parties, namely, the lender, the merchant and the consumer. The BNPL lender often gets richer data on what the consumer is buying. We often do not see product-level data or credit card statements. We see the name of the store where we purchased but not what we purchased. This is because, historically, Visa and MasterCard networks did not carry product-level data. The BNPL lender can use product-level data for various commercially beneficial purposes, including product recommendations and credit analysis. The BNPL lender can also curtail her credit risk at the transaction level. This in turn opens up a larger target market. A lender can deny a credit card to a customer with a low credit score, but may approve one transaction. The merchant benefits from a higher purchase rate, at least for higher-priced items, where the consumer is more likely to buy on BNPL over credit cards. Additionally, the merchant can customize the fees she pays to the lender based on the unit being sold. For example, the merchant may pay the BNPL lender a higher fees for slow-moving inventory and a lower fees for popular items. In credit cards, the fees paid by merchants vary by less fine-grained criteria. For instance, a merchant may pay higher fees for e-commerce over in-store. Finally, the consumer can plan her finances better, carefully choosing what items she wants to buy on credit. Also, a part of the commercial benefits that we just saw accruing to the lender and the merchant is passed to the consumer. For example, if the merchant is willing to pay a large fees for a slow-moving item to the lender, the consumer may have to pay 0 interest. Some of the product-level limitations on credit cards do not apply in private label cards where a deep integration exists between the systems of the retailer and the card-issuing bank. Now we will conclude this lesson with the final zone of the Venn diagram with a discussion of pure credit products. Consumer loans can be categorized into secured and unsecured. In secured loans, the lender has the right to seize a borrower-owned asset in case of non-payment. The asset that the borrower can seize is called collateral. A home loan is example of a secured loan. The home is the collateral. In unsecured loans, there is no collateral that secures the loan in case of a default. Hence interest rates are higher than on secured loans to offset the greater risk. Credit card debt is unsecured. The 2 main types of secured consumer loans are mortgage loans and auto loans. Next we will learn about each of them. A consumer mortgage is a loan made to finance the purchase of real estate for a non-business end use. This includes properties where the owner lives as well as properties that are rented out. The real estate serves as collateral, which means that the lender can possess the property in case of non-payment and sell it to recover its loan. The lender earns fees at origination and interest during the period it holds the loan. The two key terms that matter to the borrower are the duration and interest rate. Fixed-rate mortgages have a fixed rate over the life of the loan, while adjustable-rate mortgages have a fixed rate over an initial predefined period and then change over time. An important distinction within mortgages is between financing of residential properties versus commercial properties like hotels, offices, and shops. From a lender's perspective, consumer-focused residential mortgages have lower risk as the repayment is typically dependent on a stable income source like wages. Commercial mortgages, which we will cover in the lesson on wholesale banking, are riskier, because the owner's ability to repay is dependent on the fortunes of the business tied to the property. On the other hand, the regulatory burden on lenders is higher in case of consumer mortgages. A middle zone exists between residential and commercial mortgages with respect to loans taken to purchase multifamily properties, which are residential buildings with more than one housing unit. Whether these are classified as residential or commercial depends on the number of units involved, with larger number of units considered commercial. An auto loan is a loan to finance the purchase of a vehicle. The vehicle being purchased forms the collateral. Lending can be for new vehicles or used vehicles. Banks compete with the captive financing arms of auto manufacturers. There are two models banks can follow in consumer auto lending: direct and indirect. Next, let us look at each one. In the direct model, Kathy, a car buyer, first goes to a bank where she is approved for a loan up to a certain amount at a specified rate. Armed with this pre-approval, she goes to the dealership to shop around for a car that fits her needs and budget. In today's digital world, some banks would pre-approve a loan for Kathy via a digital app. In the indirect model, Kathy, the car buyer, goes to the dealership. She selects a car and the dealer then submits a loan application on her behalf to multiple lenders. The lenders could be banks, non-banks, as well as captive financing arms of car manufacturers. Also, in an increasingly digital world, the purchase of the car and the sourcing of the car loan may occur online. An auto lease is similar to an auto loan, in that, it is used to purchase a vehicle. But in a lease, the financier owns the vehicle. The financier is called the lessor and the borrower is called the lessee. The payments made by the lessee in an auto lease is similar to paying rent to a landlord, while payments made on an auto loan are equivalent to paying a mortgage lender. At the end of the lease, the lessee can either return the vehicle to the lessor or buy the vehicle at a negotiated residual value. To close our discussion on credit products, we can now move from secured loans to unsecured loans. We have already covered the two major forms of unsecured loans, credit cards and BNPL. Unsecured personal loans form the third big category of unsecured loans. These are non-card loans made on an unsecured basis. There are three important themes that impact consumer lending, and we will briefly look at each. These are securitization, credit risk, and consumer protection regulation. In our previous lesson on capital markets, we saw that securitization was the process by which a consumer loans are pooled together and the cash flows on the pool of loans backs debt securities. In our illustration, the bank on the left had originated $100 million of mortgage loans and created 100,000 securities, each with a face value of $1,000. We will not repeat the discussion here except to note that securitizations are a big feature of all types of consumer loans, not just mortgages. The lender earns origination fees while most of the interest goes to the investors in the securities. In consumer lending, we can distinguish between three roles. The first role is the originator of the loan. Banks play a big part here in screening loan applications and taking lending decisions. The second role is of the securitizer. The originator may choose to perform this role themselves. However, this role can also exist in a decoupled state. In the U.S., entities like Freddie Mac and Fannie Mae buy the loans from the originating lender and securitize them. The final role is that of the loan servicer, who performs customer service and ensure customers are being billed accurately. Servicing could also mean servicing the investors in the securitization and ensuring they are receiving correct distributions. A bank can choose to perform one or all of these roles. For example, some banks buy mortgage servicing rights for loans originated by other lenders and get paid a fees for this service. Within the context of consumer lending, credit risk can be assumed by one of three entities. First, the loan originator can hold the loan and retain the risk. Second, as we just saw, the credit risk can be transferred to the investors in the securitization. Finally, There are models where the loan is originated by a bank in conformance with the guidelines of a government entity that guarantees the loan. An example is loans made by the Small Business Administration or SBA in the U.S. The small business applies to a bank and the loan is dispersed through the bank, but the underlying risk is held by SBA. A consumer lender may rely on two sources of information for making a loan decision. The first is a third-party credit score. A consumer credit score is a symbolic representation of the likelihood of an individual to repay her debt, typically assigned by a third-party agency. These scores are derived from past payment history of consumers. An example is the FICO score in the U.S. For small value loans like credit cards, banks may exclusively rely on these scores. But as the loans get bigger, lenders augment third-party credit scores with their own analysis. For instance, when evaluating a mortgage application, the lender may ask for pay stubs and bank statements. The thin file problem in consumer lending refers to the problem that arises when an individual lacks a history of borrowing, because of which it is difficult to assign credit score. This is because traditional credit scores, like the FICO score in the U.S., depend on past repayment history of loans. But consider a young professional who is just starting her life and has never held a car loan or a mortgage, or an immigrant who has just arrived new to a country. These people will either be denied credit or have to pay a high interest rate. The thin file problem can be solved through alternate data, which within the context of consumer lending, means data sets outside past repayment history that can be used to predict likelihood of loan repayment. Such data sets include income and expenditure data, repayment history of bills like utility and cell phone bills, employment history and educational background. While banking regulation is a vast topic that we will cover in a separate lesson, this is a good time to talk about regulation within the context of consumer lending. While the regulatory regime in each country is different, there are three broad themes within the context of consumer credit. The first is around transparent disclosure of terms like interest rates and late fees. The second is prevention of discrimination in lending based on demographic factors like race, religion, and gender. Finally, regulations prohibit use of abusive, unfair, or deceptive practices in scenarios where the borrower is delinquent and the lender is seeking to collect its dues. This brings us to the end of the module on consumer banking. We have covered both the cash management and credit side. We will cover wholesale banking in the next lesson. Before proceeding, review the summing up section of this lesson. See you soon.